I'm Jim Costello. I'm Chief Economist for MSCI's Real Assets team. I am in Nashville today, Music City. I just spoke at the IREI Springboard event, and it was an interesting talk for me. For me personally, it was interesting because I was providing some perspective to a group of young leaders in the industry to help them think about real estate investment in this uncertain economic environment and what comes next and how to think about what comes next. What I started with was just highlighting some of the economic trends, but highlighting not just the numbers, but how to think about the numbers and how sometimes, what's the headline number doesn't reflect reality. We have this echo effect from COVID. It drove tremendous changes in a lot of economic indicators, and then activity just zigged and zagged back and forth. I love using analogies sometimes, and the one I used was a rubber band. You pull a rubber band between your fingers, you snap it big in one direction and let go, and it reverberates back and forth. There's indicators like e-commerce sales, some of the investment components of GDP. Things are just swinging around, and people have to make sure that they're making an investment not based on one of the zigs or zags, but based on what was the fundamental trend through all that noise. And that becomes a challenge because some people, I think, are misreading a little bit of what was happening with the recovery period from COVID. And then we hit the current environment of high interest rates, uncertainty over energy, and just a lot of hand-wringing over whether we hit a recession or not. And one of the key messages I had for this audience was that as we head into these uncertain times, the most important thing that they should be focused on is their reputation. Again, this is a group of younger professionals who just now have not really worked through a downturn. And one of the challenges in downturns is investments lose money. And how you communicate challenges around that to investors, in some ways, is far more important than providing any solutions to that. If you know you're running into trouble, and if you know you have challenges ahead, to be on top of that and communicating with investors and just being present with them is far more important than suddenly pulling a rabbit out of your hat and saving the investment. The predictability and understanding what's happening and knowing you're a good partner and knowing that you're communicating and trying to help them becomes far more important over the next 20 years of their careers. And that was one of the key issues that I brought up with everybody. But we do face some challenges ahead. The deal market is starting to freeze in a number of parts of the United States. The cost of capital is going up in the debt portion of the capital stack. Mortgage rates are surging as interest rates are surging and the Fed funds rate surges. It's all going up on that part of the stack. And so in some cases, mortgage rates are higher than cap rates of the handful of properties that are trading. Transactions are always a backward-looking indicator. You have a deal that gets started and it gets closed 20 weeks to 6 months later. So deals that closed in August weren't really priced at the fundamentals of the debt market and interest rates in August. It was in the previous months where everything was a little bit easier to get the deals done. So we have a challenge heading into the rest of the fall for people to get a deal completed, just given the higher cost of debt today relative to a year ago. One of the issues is that property owners, they don't want to take a loss. Nobody wants to take a loss unless they're forced to. So nobody's moved their cap rates yet. Nobody's been willing to sell at a lower price today. And then with their appraisals for just ongoing reporting for investors, the appraisers that I talk to in the industry, none of them have been moving cap rates yet. Their attitude is that, well, I don't see any comparables yet. You guys at MSCI don't have anything in your RCA database showing that the individual deals have changed yet. And they're right. In that backward-looking basis, there's nothing there yet. Nobody wants to take a loss. And really, nobody's being forced to take a loss yet. If I hold an asset and I'm still making my cash flow and I'm still paying the loan, why should I sell at a discount relative to what I would have gotten a year ago? Why not just hold on to it and see what happens? And I think it continues like that for a bit. And that could continue to limit deal volume for a while unless some group of investors decides that they really want to be in real estate for something other than the income growth potential and maybe some sort of capital preservation play. But that's a smaller segment of the market. So we have a challenge here. Buyers and sellers further apart. Prices haven't really moved yet. In this case, though, the REIT market, I think, provides an interesting forward-looking indicator. It didn't during the early part of the COVID pandemic. REIT price shares were down quite a lot, suggesting that the asset values were down. But the actual property market was pretty flat. We didn't see a big decline in prices. This time, the REIT market is again down sharply. Investors are looking at sort of the debt position of REITs, the income potential, and just marking the NAVs down. Actual transactions, things that have sold, you don't see many changes yet because it's a small slice of the market, the highest quality stuff that's selling. And so there's a bit of a disconnect. That said, the broader market faces some challenges. And I think this time through, maybe the REITs would be a good indicator for us because you don't have something like the CARES Act coming in to save anybody. In fact, we have the opposite situation. The Fed continues to tighten. And really, they kind of have to tighten. They have to put this inflation genie back in the bottle as forcefully as possible. And so they've signaled that they want to continue tightening until they've got this thing solved. So I think we have a challenge this time that we didn't in that last part in the early part of the COVID pandemic. And that creates more downside potential for pricing and valuations. Again, though, the appraisers haven't moved yet, in part because they haven't seen the data points suggesting that they should move. This kind of environment, though, I should be the guy, given my company, saying that only look at data, only look at data. That said, I think you have to make reasonable judgments about investments, and I think you have to use common sense and look at other indicators to get a sense of values. If investors are pricing the debt of corporate tenants at a higher rate today because they're more worried about those investors, those corporate tenants paying their loans back, should you provide a premium still for the rental streams coming from those corporate tenants? I'm not sure most investors would want to do that. And so even if you don't see the comparables out there to underwrite stuff differently, maybe there are other data points in the industry that can be used to make decisions. I don't think it's a sufficient point at this time in the cycle to just bury your head in the sand and say, I don't see any comparables.